will the Fed revalue gold at a higher level in order to book a profit? Whatever level they book it at, higher than the $42.22, they'll make a profit.
Yeah.
The reason I got to 15,000 would be it's enough to pay off this year's deficit and next year's deficit and reduce the national debt a little bit. It won't reduce it that much. But of course, there's plenty of people who think, well, they should do it at a much higher level to pay off the whole of the national debt. I think that's too risky.
If they revalued it to 15,000 overnight, yeah, it would be quite dramatic for not just Newmont, but all the other miners.
Clive Thompson, a retired wealth manager with decades of experience handling high net worth portfolios, has projected a gold price target few are willing to say out loud: $15,000 per ounce. This isn't a marketing pitch or a guess. Thompson's thesis is rooted in the idea of Treasury revaluation, a move he believes could become necessary as the U.S. faces deepening fiscal stress. Recent market behavior adds weight to his argument. Investors are leaning into gold, not as a speculative play, but as a shield. Slowing economic indicators and mounting policy uncertainty are forcing capital to seek safety. Thompson's stance is blunt. There's no such thing as being too bullish on gold in a world where fiat currencies are structurally losing value. Money is going to zero, he says, while gold is one of the few assets trending the other direction. He's not alone in that view. Analysts at the Gold Bullion Company expect gold prices to remain elevated through 2025. Corrections may come, but the long-term thesis remains intact. Gold is still the anchor when everything else feels unsteady. Macro conditions support this outlook. With economic contraction forecasted for 2025 and tariff impacts still working their way through the system, recession odds are climbing. That's historically bullish for gold. Add in central banks stuck between controlling inflation and maintaining financial stability, and you have a setup where real assets outperform paper ones. The core of the gold case is simple: purchasing power erosion. Since the US left the gold standard, the dollar has lost more than 90% of its value. What $1 could buy in 1970 now takes over $7. That's not just inflation, it's policy by design. Thompson's $15,000 target may seem aggressive, but the logic behind it isn't. If the global monetary system keeps leaning on debt, dilution, and devaluation, gold isn't just going higher, it's going to where trust goes when currencies fail. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I don't think you can be too bullish if you're in it for the long term. But if you're a short-term trader, it's perfectly in order to jump around from short to long and long to short all the time and try and second-guess the market. And, perhaps if we go back a few days ago before the latest jobs report last week, it did look like silver and gold were coming under a lot of pressure, as were equities. Well, equities were doing all right, but then suddenly everything flipped. We had the jobs report, and gold and silver jumped up, and equities went down. So all those people who were thinking that gold's going to go down last week and were selling it with the hope of buying it back later at a lower price kind of got messed up by the surprise, the really awful number from the jobs report. So people sort of rushed to the safety, didn't they? They rushed to the safety of gold. But I think long run, I don't think there is such a word as too bullish, because money is going to zero. So where does that leave gold at the end of the day? It leaves it at infinity at some future date. We don't know when that will come. I saw one which was a bit earlier addressed to me, Mario. One of your viewers said, where does Clive get his $15,000 gold prediction from? Or why 15,000? I was talking, that was in the context of, will the Fed revalue gold at a higher level in order to book a profit? Whatever level they book it at, higher than the $42.22, they'll make a profit. The reason I got to 15,000 would be it's enough to pay off this year's deficit and next year's deficit and reduce the national debt a little bit. It won't reduce it that much. But of course, there's plenty of people who think, well, they should do it at a much higher level to pay off the whole of the national debt. I think that's too risky, but I think there's no problem if they do change the price of gold. The question which everyone will have is, if they change the statutory price of gold from $42.22 to today's price or some other level, Will that put a floor under the gold market at the new level? Well, we don't know that. But obviously, a lot of gold bugs, myself included, wouldn't object if the price of gold is underpinned by a new statutory price from the Fed, or not from the Fed, from the Treasury. I happen to be an owner of some shares in Newmont Mining, so I'd be very happy if it went up to any figure above where it is now. I'm showing a little bit of let's say a little profit at the moment, but yes, of course, if the gold price gets revalued, and this is the important point, underpinned by a bid from the Treasury, because that's really important that it's got to have the bid as well. Nobody's going to sell the gold for less than the bid anywhere on the
No.
planet, and that means the gold mining shares would do very well. One of the things I've learned in my 50 years of investing is to heed warnings. And I suppose most of my career I didn't heed them. But the one which resonated most in my mind was prior to the 2008 global financial crisis. I was reading in reputable newspapers like the Wall Street Journal and the Economist about the impending housing price crash. They were giving specific examples of these loans which were being made to people who had no chance of ever repaying them. And they said it's going to be a big problem. This is long before it actually was a problem. And you know what? I read it, shrugged my shoulders, and carried on investing.
Yeah.
But now I think if I hear a warning, I pay much closer attention to it. And I think the world is getting a warning about the fiat system, the rising level of distrust in our central banks, and the ability to manage the nation's money supply and manage the nation's debt. That's obviously not the central bank's role to manage the debt. But it does seem that governments have lost control of the financial system. They're basically on a borrow, 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 and there's no end to it. Well, if a small amount of money leaves the stock market, which probably represents 60–70% of people's portfolios globally, and moves into gold, which probably represents 1% if we're lucky globally, it could really spike the gold price. And of course, silver is only, the above ground supply of silver is only 1/10 of that of gold, and platinum is only 1/10 of silver. So any money moving into the precious metal sector could spark them all big time. I don't think I've ever had confidence in the labor statistics. They revise these numbers almost every month. They revise the previous months down. And the fact they revised the earlier months down by 258,000 jobs and then said, we've got an increase of 73,000. Well, that's an increase of 73,000 on a number which they reduced, a previous month number, they reduced by 258,000. So actually, the reality here is we've lost 212,000 jobs. We lost, they've 200,000 jobs. Now I've done the maths wrong. 180,000 jobs, something like that. Because the effect of revising down the previous month's number makes the current number look that much better. So they're very lucky that they got 73,000 when they should have been reporting a loss of 180, 190,000. But to keep pace with immigration, they need a positive number every month of about 100,000.
Well,
And that's not happening. The other figure, which was pretty awful, was the household survey. That came in, I'm just looking here if I've got the figure, but it came in with a pretty awful number. The household survey is another jobs survey. It says I just read this, the household survey, which forms the basis for unemployment rate calculations, showed an even more concerning decline of 260,000 workers, while labour force participation rate dropped to 62%, its lowest level since November 22, 3 years ago. More alarming, the average duration of unemployment jumped to 24.1 weeks, the highest since the COVID pandemic in April 22, as it was ending, suggesting that the job market weakness is becoming entrenched rather than transitory. Well, we're seeing that rates remain elevated for 10-year bonds, for example, or 30-year bonds, they're rising. So despite multiple cuts all around the world in interest rates, the longer-term bonds are not reacting because people are saying these cuts aren't really reflecting the reality of things. What we're in is a world in which the amount of government debt continues to rise and a world in which the amount of money in circulation continues to rise. And therefore, if I'm buying a 10-year bond, I don't want to get a 2% yield. I want to have a 4% yield or a 3% yield. I want a higher level of yield to compensate me for the fact that you guys are printing like there's no tomorrow and borrowing money you can't repay.
MarioInnecco, a financial markets analyst with a sharp eye on macro trends, says we're not just looking at another precious metals bull run. What's unfolding is a systemic breakdown of the fiat currency model itself. That's why gold and silver, to him, aren't merely vehicles for profit. They're essential safe havens for anyone paying attention. The numbers back this up. Since 1971, when the US severed its link between the dollar and gold, gold's purchasing power has increased by over 13,000%. In contrast, food prices have increased by 2,600% over the same period. That gap isn't an accident. It's proof that while fiat currencies lose value, gold holds its value. Innecco sees this divergence widening during what he calls an approaching currency reset. With central banks boxed in by decades of debt and unchecked monetary expansion, gold and silver could serve as anchors between collapsing systems and whatever replaces them. It's not a doomsday call, it's a recognition of where policy failures and math eventually collide. What makes this more urgent is the illusion of dollar strength. Innecco views the dollar's recent bounce not as stability, but as a warning sign. Like the calm before a monetary storm, temporary strength can mask deeper structural rot. When the next wave hits, whether sparked by a debt crisis, inflation, or geopolitical stress, most investors will be late to act. Innecco's message is blunt. You don't wait for the collapse to prepare. You position ahead of it, and that means gold and silver. Let's get back to the interview.
I wanted to look at another article which tells me that people are losing faith in bonds. This is Japanese Farmers Bank vows caution after 12 billion loss from Treasury's back. So that's the Norinchukin Bank. Yeah, new chief says cooperative known for voracious buying of U.S. debt had taken positions that were too risky. So I think it's not only treasuries, but also JGBs. I think people are going to be a lot more cautious. I would say, Clive, in, maybe 2 years, but definitely in 5 years' time, this 60-40 rule that you have to hold 60% of assets if you manage money in stocks and 40% in bonds, that's going to be out the window. And I think gold, silver, and what they call alternative assets are going to be a lot more important. You probably pay now like $12 for it. So you can do the maths. So it's about, a fifth of that. So about $2.50, the silver amount of the dime. But anyway, Chris Conman, thank you for your super chat. If gold is revalued to 15,000, will Newmont stock shoot up to 300 overnight? Thanks. I think it would. It would shoot up quite high. Right now, it's trading around 63, 64. And I think last year it bottomed around 30. And I have some Newmont, and I think it looks really bullish. I think 100 is a realistic target as is. So I personally would say that if they revalued it to 15,000 overnight, it would be quite dramatic for not just Newmont, but all the other miners. CAD 1050. What's your thoughts on UK Royal Mint DigiGold and DigiSilver? They say it's fully backed by gold and silver in their vaults. I've seen those DigiGold and silver from the Royal Mint. I don't trust them as far as I could throw the Royal Mint. Yes, the coins they mint, the gold and silver coins, are legitimate, but I wouldn't deal with them. I wouldn't send them any money for them to store DigiGold or silver to me. I think one of the reasons they do it is because the government, the Treasury, and the Bank of England have told them, try to keep people from buying real gold and silver. Start this DigiGold, DigiSilver. Yeah, I would. That's not the way to buy gold and silver. Because normally you can have a bull market in precious metals as we had in the early 2000s and so on. But now I think it's more than a bull market. It's the fiat currency system really on the ropes. And that's more than a bull market, in my opinion, Clive, for gold and silver. It's the place where you want to be, really, because it's like you see a tsunami coming. That I think it was 2004, that Banda Aceh tsunami, and you got to run. And this tsunami is coming, and you can't stay by the beach waiting for it. And do you remember that? I think what happened before the waves came back then, that it looked like the tide went out, like the water just was sucked off, and people stayed there. But it's something really unusual. But that was because of the tsunami. And yeah, and it's kind of like maybe you could see the dollar rise quite sharply when things get really bad. But that would be the analogy would be the tide going out, or the sea going out before the tsunami. I mean, Clive, I've always believed that central banks, they're not really you can't profess to have free markets and have central banks, because it's basically a monopoly, and it controls the price of money and credit. I think it should be done through the market, through the free market. Yeah, the Fed is always like makes mistakes. This is not the first time, but I wanted to bring up a couple of charts here, Clive. The first one is gold to S&P ratio. So it's not S&P to gold ratio. It's the other way around. And I look at it. I mean, I'm only going back to 2011. It was a lot higher in 2000. It went a lot higher in 2000. So it means that, lower in 2000. But in 2011, it peaked here, because when gold went to like 1900. And I think we've got a lot of room. We've had a bit of a consolidation here where the stock market outperformed, but it seems to be breaking a falling wedge, which in my book is quite bullish. We could go a lot higher than the high in 2011, which is about just over 3 times where we are now in relationship to the S&P. So, and I think the downside here, Clive, is quite fairly limited. I'd say this 0.4 area is like is a huge support. It held here, and it held back here as well. And I've got the Dow gold ratio, and we had the same consolidation up for the Dow gold ratio. And on Friday, Clive, it broke below that. So I think we could have a really interesting final 4 months of the year. When you lived in Brazil and hyperinflation kicked in, how was metals used for transactions? Well, there was no one used gold and silver in Brazil. They used the dollar, because back in the 80s, the dollar was still like, and even today, Brazilians use the dollar. So if you had dollars, you were fine. I never no one ever talked about gold and silver in Brazil when there was the hyperinflation. It's weird. I really only learned about gold and silver as money, back in the late 90s, early 2000s, when I was already in the UK.
What's often dismissed as alarmism is starting to look like realism. Gold and silver aren't moving because of hype. They're moving because the foundation beneath global currencies is cracking in plain sight. Each policy patch, each debt ceiling drama, each round of monetary easing signals the same thing. The current system is unsustainable. Meanwhile, those watching quietly are making moves. They're shifting into assets that don't rely on promises and that don't inflate away. Not because they expect collapse tomorrow, but because they recognize that the architecture of money is being rewritten in slow motion. When the tools designed to stabilize economies start eroding trust instead, what holds value when belief in the system no longer does? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.